Fair enough. All right. Okay, FIIs then. I mean, honestly, the reason why we have seen that exit is there are plenty of them. I mean, look at the valuations that Indian markets are commanding. To a certain extent, I truly believe that if a foreign investor is getting these multiples that are in 30s and 40s versus their own home country, which is in single digits, it's obvious that they will consider selling. However, still, I would be amiss if I don't ask you this question. Do you think that the government should have done a little bit more to entice FIIs to stay in India? Because at the end of the day, most of these guys are here for the long term. And if our long term story is so promising, then something like valuations shouldn't be a reason why they're exiting. So do you think that over there the government fell short?
No, I don't think so. I think the government did everything that it could to make FIIs happy. And I'll start off with first and foremost, the fiscal discipline, right? Both in terms of committing to the fiscal deficit and living up to for the current year, and for projecting a 10 basis points drop in the fiscal deficit, plus taking on a debt to GDP burden being dropped. I think all those are good news, because ultimately FIIs in an emerging country are more worried about risk than about the reward potential. That's number one. So I think the government did it with a very good job in terms of maintaining fiscal discipline and the thought process, number one. Number two, you talked about growth story. The India's valuations are always been at a high level relative to the emerging market, because we are competing for the emerging market pool of FIIs. We're not competing with money going back into the developed countries. Remember that. Within the emerging markets, we've always carried a premium. It's just that the period amount has come up or come down. And why is that premium being made? It's because of the long-term growth story. Now, what has happened to the long-term growth story? Well, the tariff and the fact that India and US are not on good terms in terms of trade is what has hurt it, because the US is the single largest country in the world, carrying 25 to 28% of the world GDP, with a $19,000 per capita income, had the capacity to absorb all that population-driven strength of manufacturing products at a low price from India. But unless this tariff situation is solved, that future is not looking as bright as it was before this whole thing came. So I think it's the Indo-US trade deal which will be a trigger, because India is not traded on PE ratios, it's traded on PEG ratios, which is PEG is taking the growth in the EPS growth. So that's where before September 2024, our story was looking bright and beautiful. After September 24, a number of these events have taken place to say that, are we ready to go into a double-digit GDP growth phase? Before, yes, but now not so sure. So once the US trade deal, and 40% of FIIs are domiciled in the US who come into India. So clearly the US connection is very important, and I think that's far more important. But like I said, when they're entering into a risky space like emerging markets, for them the risk quality, Standard & Poor's upgradation of India was an important step there, but we have to make sure that we are not buying growth at the cost of risk. And that's where the government has done a very good job. So I disagree with the view that's there in the market that the budget has not done enough FIIs. As far as FIIs, the rating agencies are an important factor there, and I think they have managed that very well.